Let's take a look at Chapter 16, starts on page 823 of the book, and our last chapter. So listen to this and have a smile on your face because we're almost to the end. We're very close. We can see it from here. Objectives of this chapter. CVP stands for cost, volume, profit. So you're going to hear me say that a lot, CVP. And we use this information to help us figure out break-even point. And break-even point, we'll get into what that means. Basically, how much do I have to sell to break even? Not have a loss, but yet not have a profit. And then we can take break even, add a target profit goal to that, which then gives us a, here's how much I have to sell to make this amount of money. Here's my, if I want a profit goal of X, I have to sell so many units to achieve that goal. And so we can do that with before tax, after tax. We can apply that same information to a multiple product setting, a company that sells more than one product, which obviously is almost everybody. I'm not going to cover the graphs with you, but you could put together a cost volume graph. I'm going to skip that part of the chapter. Explain the impact of risk, uncertainty, and changing variables in CVP. And it is, you have to have assumptions when you do CVP. And of course, whenever you have an assumption, reality could turn out to be something else. So that's what they talk about between risk and uncertainty. And then we'll talk about non-unit cost drivers on CVP also. Okay, so cost, volume, profit, CVP, powerful tool for planning and decision making. And that's really where it's useful is if we've got a pretty good handle on our costing and our volume, we can turn that into profit analysis, right? So basically saying, if I sell this much product, I can make this much money. Brings together all the financial information of the firm. Frequently used approaches to finding the break-even point. So the first thing we'll do is figure out break-even point. Once we've got that figured out, we can use that to add a target profit and basically say, what do I have to sell above break-even to achieve a certain goal of some certain profitability. There's two main ways to do it, operating income approach and the contribution margin approach. And again, the break-even point is the point where we have zero profit, we have no profit but no loss. We've sold exactly enough product to cover all the costs of manufacturing, selling, distributing, paying for administrative expenses, all those costs. The cost and revenues are zero. They add up to be zero when we compare them together. Now, of the two methods, operating income and contribution margin, my favorite, the one I like the best, is contribution margin, and you'll see why when we get into it. So I will just tell you that of the two, I think contribution margin is much more straightforward and much more easier to understand. The first step in implementing a unit sold approach to CVP is to determine just what a unit is. And they talk about that just a little bit on the top of 823 when they first start the chapter. If I'm a service firm versus a manufacturer, what is a unit? They give examples of Delta Air, Delta Air, a couple different airlines, Mayo Clinic, Procter & Gamble, JetBlue. What is a unit? Is it a unit, a person on a flight, or is it a per mile rate? Is it days you stay at an amusement park? Whatever that is, you first of all have to figure out what your unit is, and that's up to the company, right, of what that unit is. But that's the first step. Second step is to separate costs into fixed and variable. Okay, so we've talked a lot in this class about what a fixed cost is versus a variable cost. We talked about mixed costs where we separated a cost and said a portion of the cost is fixed and a portion is variable. So we've done all that kind of stuff. CVP focuses on the firm as a whole. Okay, all costs of the company, everything, not just the manufacturing, but the marketing and administrative are taken into account. All costs, right? Because we're doing this break-even stuff, and so break-even implies how much do I have to sell to break even with all of my costs that I'm going to incur. So the basic concept of CVP then, a useful tool for organizing the firm's costs into fixed and variable categories, is what they call the contribution margin income statement. Okay, the contribution margin income statement is I get operating income, which is income before taxes, includes only revenues and expenses from my normal operations. Net income is operating income minus income taxes. So if you looked at a traditional income statement where you have your revenues minus cost of goods sold to get to gross profit, then all of your various operating expenses kind of broken up between selling and administrative. After you take all those into account, you get an operating income number. Then from your operating income, what businesses do is they subtract taxes or things that are kind of unusual, kind of extraordinary items or items that management really can't control. The goal of having an operating income line is that's operating income based on decisions that management made, what they could control. There's always some line items on a financial statement that are impacted by outside economic things that management can't control. And so typically we don't include those in operating income. Net income is the very bottom line after everything's taken into account. So the first method we'll look at is the net equation method to break even, the one that I'm not a big fan of, but I just want you to be aware of it. The one I like better is the contribution margin approach. But the equation method begins on page 826. Now I will also tell you that our final test is based on 3 chapters, 11, 13, and 16. 11 and 13 were much more on the qualitative side than the quantitative side. The number crunching you were doing in Cengage now for those chapters isn't quite as heavy as it will be here. So this chapter is going to be more on the quantitative side, which is kind of what we had when we first started the class a few weeks ago. But just so you're aware of that, this is going to be much more a number crunching chapter. And so with that in mind, I want you to pay attention to the various cornerstones that are built into the chapter. For example, there's one right away. Cornerstone 16.1 is on page 825. And with that one, they're having you compute some formulas. They're having you compute variable cost per unit, selling expense per unit, contribution margin ratio, and a few things like that. So right away, work on that. Just get into that. And it's not hard to compute these. I mean, they really are not tough. I don't think you'll struggle too bad with them. It's just a matter of taking the data given to you and plugging in kind of the right information. And so I want you to walk through that one on page 825. Make sure you do that. And then, of course, they'll do that kind of for every concept that we have here. They'll go ahead and show us a cornerstone. So page 827 has another cornerstone, for example. But so do those on your own, or just look at them in the chapter. And of course, there's the cornerstones at the end of the chapter. And what I'm going to do when we do the WebEx for chapter 16, I'm going to try to spend some time in that WebEx working a few of these examples with you. I'll pick a few exercises out that I think will be helpful, and we'll go through them together in a WebEx. So that'll be a recording of kind of how to do some of these also. So just know that's coming. So the equation method, you can see here, it says operating income equals sales revenue minus variable expenses minus fixed expenses. So be aware of that. I want you to know that. That could easily come up on a test or a quiz, just the concept of what operating income is. And so once you know what operating income is, just break it down into pieces. That's the next step here. So sales revenue is price times number of units sold. That's my sales revenue. Variable expenses is my variable cost per unit times the number of units sold. And then, of course, I subtract from my fixed expenses. So we're just taking operating income and breaking it down to price times something for revenue and for the variable cost. The equation method for break-even and target income, just to continue that thought here, it says the equation for a target profit in terms of units is, units for a target profit is total fixed cost plus target income, so total fixed cost plus target income divided by price minus my variable cost per unit. Okay, so break even, we set break even at target income being 0. So the break even formula can also be used to say how much do I have to sell to come up with a target profit number. So the break even formula is really at the bottom here. Total fixed cost plus 0 which is my target income being set at 0, divided by price per unit, minus variable cost per unit. Okay, that's my equation method. And I can add a target profit to say, obviously if I add a target profit, I have to sell more than break even to achieve that target profit. That's what they mean by that. So that's one approach, the formula approach. So walk through that on page 826 and look at the cornerstone in 827. Now the method that I think is better, that I think is more intuitive, more straightforward, more just easier to understand, is the contribution margin approach. Okay, and so that is on pages 828 and 829. So understand the word contribution margin first of all, and make sure you've got that down in your brain. And it's simply sales minus variable cost. So CM equals sales minus variable cost. So if you wrote that down on a piece of paper, write S for sales equals, I'm sorry, let me back up. CM, contribution margin, equals sales minus variable cost. So CM equals S minus VC. Okay, that's contribution margin. Know that. Just have it written down in some notes. Commit that to memory if you can. Just understanding that basic concept helps you as you compute some of these questions they're going to give us. It says by substituting the unit contribution margin for price minus unit variable cost in the operating income equation, the break even is this. So number of units to break even is fixed cost divided by unit contribution margin. And my unit contribution margin is sales minus variable cost, both per unit. So the word contribution, we're contributing to our fixed cost. So every time I sell a product, I subtract out my variable cost per unit, and what's left over is what I have that contributes to paying for my fixed cost. So that's why we call it contribution margin. I'm contributing to pay for my fixed cost. And you see this on the bottom of page 829, and it says for a $10 product, if I have variable cost at, and I'm not sure exactly how much that is, it's above, let's just say it's $6. That means my contribution margin is $4, right? So my revenue of 10 minus my variable cost of 4, my variable cost of 6 equals my contribution margin of 4. That's what that really means. And that contribution margin that contributes to paying for my fixed cost. And if I know what my total fixed cost is, then I could figure out how many units do I have to sell to pay for my fixed cost, and knowing that anything I sell above and beyond what has to pay for my fixed cost is profit. So if I have to sell 10 units to cover my fixed cost, if I sell 11 units, I just made a bottom line of $4. That's what that means. Okay, so break even and target income and sales revenue, top of page 829. A unit sold measure can be converted to sales revenue measure by multiplying unit sales price by unit sold. Okay, which just simple math. To calculate break-even point in sales revenue, variable costs are defined as percent of sales rather than amount per sold. So what we can do is, I said, here's my contribution margin in dollars, but now I can have a contribution margin as a percent. So I can have a contribution margin as a number or a contribution margin as a percent. So if I go back a screen and I go, my contribution margin here is $4, if we're assuming that variable cost is 6, which I think it is based on where this line is between blue and orange. So if my contribution margin is 4, 4 divided by $10 is my contribution margin ratio of 40%. So that's what this screen is basically saying. I can take a contribution margin as a number and turn it into a percent. So sales minus revenue approach, operating income equals sales minus variable cost minus fixed cost. Therefore, operating income equals sales minus my variable cost ratio times sales divided by total, or subtracting then total fixed cost. or operating income equals sales, which is 1 minus variable cost ratio equal minus total costs. Or I get down to here, the simplified formula after all this is rearranged, the very bottom one here, operating income equals sales times my contribution margin ratio minus total fixed costs. So, as long as I have my contribution margin either as a dollar or as a percent, I can use that to compute my contribution or my break-even in terms of units sold, or my break-even versus dollars of revenue, or my target operating income the same way. Target operating income in units sold or in dollars of sales, either way. So sales minus revenue approach, sales equals total fixed costs plus operating income divided by contribution margin ratio. Break-even sales equals total fixed cost divided by contribution margin ratio. Okay, so we just went through a whole bunch of stuff to simplify down to what I think is the most important part of this, which is right here. So I want you to think of it this way. Break-even in units is fixed cost divided by contribution margin in units, or basically per dollar, I should say. So break-even units is total fixed cost divided by my contribution margin per unit. My break-even sales is fixed cost divided by my contribution margin ratio. Okay, that's all that really means, is I can figure out break-even in units sold or my break-even in revenues, my break-even in sales. Either way, total revenues, total expenses are 0, and I have no loss, but I have no gain. Okay. Of course, I can change the formula a little bit to include my tax rate to get to a net income number. I can add one more layer to the formula if I so desire. That's really all the screen is telling us. I've taught this information from several different books, and this is the first one that actually brings in potentially doing this from an after-tax profit goal. So most of the books just focus on the operating income piece, but you can add this if you want. Okay, and again, when I walk you through something and explain the concept, it usually has much more meaning after you crunch a couple of numbers and you go, okay, it makes sense now. So based on that, take a look at Cornerstone 16.3 on page 831. You'll want to do that one, and you'll kind of see then they're going to ask you to figure out break-even in terms of sales revenue, and you'll kind of see how that's important. Because Cornerstone 16.2 on page 827 did break-even as units, and then Cornerstone 16.3 and 833 does break-even as dollars. So do them both, and you'll kind of see how we just rearrange the formula a little bit to do either one. Okay, so next is multiple product lines. We can still do break-even and some profitability stuff for a company that sells more than one product line. And when we do that, though, of course, it adds a little bit layer to figure out. So bottom of page 834 and 835 kind of walk us through that. And then there's a cornerstone that kind of gives you an example of that on page 837, Cornerstone 6.5. So total direct fixed expenses for a multi-product line, fixed costs that can be traced to each segment and would be avoided if the segment did not exist. So they kind of walk us through that on the bottom of page 834. They show us a company that has snowboards, and they make a regular and a deluxe. And so they show us sales less variable cost, which is contribution margin. They subtract direct fixed expenses, right? Those are direct costs that are traceable, direct fixed costs traceable to a product line. If that product line were to disappear, those fixed costs would also disappear. Then they have a common fixed expense, and the number on the bottom of page 834 is $550,000. And so basically, those are fixed costs that the company's incurring, but they're not traceable to either product line. They remain even if one of the segments was eliminated. So if we drop the deluxe line, we're still stuck with $550,000 of common fixed expense, for example. So the break-even point in units, when we have a multiple product line setting here, is break-even in sales equals, again, remember break-even in sales is fixed cost divided by my contribution margin ratio. But now we have to take into account a sales mix. A sales mix is the combination of products being sold by a firm. So a sales mix allows us to convert multiple product problem into a single product CVP format. Because typically, what happens is for every deluxe I sell, I'm going to sell so many regulars. That's kind of my average as I sell my product lines. That's what we're trying to get to, is what is that sales mix, and we can define what that is. The sales mix, just so you know, when you see it at the bottom of page 835, they talk about sales mix, and the PowerPoint just kind of alludes to it, but they don't really give us an example. So the example that you want to look at is on 835 on the bottom of the page. Is the combination of products being sold, and so the company they show us in the book on 834 and 835 is those snowboards, regular and deluxe. And what they do is they say they plan to sell 10,000 regulars and they plan to sell 2,500 deluxes. So my sales mix can be reduced to 100 to 25. Basically, for every 100 regulars I sell, I'd also sell 25 deluxes. And that's how you do that with the multiple product setting, is you come down to a ratio of one product to the other. And typically your regular model sells most and your deluxe sells fewer. With any product line, that's usually the way it works. So that's a good example to look at. And then they show us the break-even. They show us a break-even example then with blazing boards, which is Cornerstone 16.5 on page 837. And so they'll walk us, go through that example, and you'll see how they did it. Okay, I told you earlier I'm going to skip the graph stuff, so I'm going to keep my promise. We're going to skip right past it. Okay. And we're going to skip to assumptions in CVP. Okay, and this is on page 842 and 843. So the assumption, now I have to look at a graph to prove the assumption. Okay, so that's the downside of this. Bottom of page 842 has a graph. We assume that costs are linear. Okay, so a variable cost we assume is very linear. We talked about that earlier in the class, where a fixed cost is, if you were to graph a fixed cost, it's horizontal, right? It doesn't change no matter what the level of production is. But a variable cost, basically, I'm saying for every unit I produce, I incur X dollars of variable cost. There's a direct proportion. That's what I mean by linear. Okay. So some of the assumptions then we have to be thinking about it says price, total fixed cost, and unit variable cost can be accurately identified within a relevant range. We talked about a relevant range earlier in the class. That's basically saying at this level of production, these assumptions hold true. That's what a relevant range is. If I get above the relevant range, I have to come up with a new set of assumptions now. They're going to change because above the relevant range usually means I have to incur more fixed costs. My variable costs are going to change per unit, and so on. So the relevant range, whatever that is very important. We focus on what is, we assume that whatever we produce is what we sell, which in reality, just because we produce something doesn't mean we necessarily sell it, but that's what we're assuming. We assume a sales mix. We assume that we know what it is, and we kind of hold that sales mix to be true. And we say that the selling price and costs are assumed to be known within certainty, when in reality, if we do this analysis, and let's just say we set our price at $25 per unit, but then all of a sudden there's competition and we have to drop our price to maintain sales. Now our CVP relationship is now done, right? We have to come up with a new one now. So we have certain assumptions. We have to have assumptions for this to work, but just knowing what the assumptions are is important, so that if the assumptions change, we can redo the calculation. That's important too. So here's the graph I was alluding to in the bottom of page 842. Just some of those relationships to take a look at. And of course, relationships only hold true within a relevant range. Above or below that, our assumptions will have to change. Okay. And then what's really nice about CVP is you can do the what if game, and that's what's nice about it. And so they begin to show us that on 843, and they kind of show us then several examples after that. So on 843, what they do is they say we've got some CVP data, and it's still for this Blazing Boards company that's selling snowboards. It's the example they use in the chapter. And we're going to have three alternatives. Alternative one is advertising expenditures will increase by $16,500, which means we expect to sell more units. We're going to spend $16,500 on advertising, and we believe that will allow us to sell 100 more units. Alternative two is we're going to decrease our price from $400 per snowboard to $375, knowing that that price drop will allow us to sell more products. So we're going to sell 12,000 versus 10,000. Then it also says decreasing price. Alternative three is to decrease prices to $375 and increase advertising by $16,500. And we believe this will increase sales from 10,000 to 15,000. So basically, the question then is, what will my financial statements look like? What's my profitability going to be with these different alternatives? And that's the nice thing about CVP is if you've got a pretty good handle on those relationships, you can play the what if game, and we can say, okay, if next year we do this extra advertising and we sell 100 more units, will we get more bang for our buck? Will that increase profitability, or will it decrease it? We don't know, but let's plug in the numbers and figure it out. So big picture with these analyses, obviously there's a whole lot of assumptions that go into it. How do we know that we're going to sell 100 more units if we increase advertising? We don't know for sure. We think that's what's going to happen, or maybe we have some market research that says more product awareness will result in more sales. So it's a matter of how in tune are we with our marketing and with our customers to know that. We're looking at our competition, of course, also. And alternative two is dropping price, right? How do we know if we drop price by $25 that we can sell 2,000 more units? Well, again, it's are we doing some customer surveys? Are we doing some focus groups? Or how aware are we of what our competition is doing price-wise? How do we believe our brand image is versus the competition in terms of pricing? And if we drop pricing, is there perception that the quality has gone down? Those are all kinds of things that we're assuming the business knows, right? So you can't just pull a number out of thin air and hope it's going to work. There should be some basis for what that number is. But the point of this chapter really is just to say, based on the hypotheticals, what will happen? And so this at least allows a company to make a really, a somewhat informed decision, right? We're going to say, if we do increase advertising by 16.5, and we believe that will increase sales by 100 units, does that make sense? Bottom line, will that increase profits? Yes or no? And that's so. If we say that, if we know that with our assumption that will increase profits, then there's a better likelihood that we'll do that. Okay. Now, in the example you see here on the screen, the answer is that won't work. Okay, you can see that right here. The numbers you see here are on the top of page 844. And so units sold, this is kind of the as is, this is what we've got now. And this would be the will be, the as is and the will be with increased advertising. So what happens is my contribution margin goes up because I sold more product. That's good, but the bad news is that my fixed cost went up more than my contribution margin by $500. Okay, so this plan will not work. I'm going to lose $500. So I basically would just say that's not going to work. My sales would have to be more than 100 units for this to work. Okay, so if that advertising level increases units sold by 100, that's not enough to cover the cost of my advertising. I would not adopt that strategy. Okay, alternative two, and if you recall that alternative, it was to decrease price from $400 down to $375. And what they did is just say, what's my contribution margin for the two price levels? So my old contribution margin was $160 per unit, which is my sales price minus my variable cost, times 10,000 units. Now, in the new model, by dropping my sales price, none of my costs are changing. My variable cost is the same. my fixed costs are the same, so therefore my contribution margin is going to go down by the $25. So I reduce price by 25, my contribution margin goes down by 25, but I sold 2,000 more units. And that works. That increases contribution margin in total by 20,000. So we're going, okay, yeah, okay, that'll work. And the last one was to combine the two together and basically say, let's drop price and let's increase advertising. And so we're basically saying that combination will increase profit by 3,500. So that's what the third alternative was. So that's the nice thing about CVP is I can do that what if scenario. Of course, there's always lots of assumptions that go into it. And I always hear that in the classroom. Well, how do we know? Well, the answer is we don't know for sure, but we're just hoping that the company has some good data to base these decisions on. Okay, next is introducing risk and uncertainty. That kind of starts on the bottom of page 345 and continues through 346 and 347. And margin of safety. And there's a Cornerstone 16.6 on page 846 that talks about the margin of safety. It says units sold or expected to be sold for the revenue earned or expected to be earned above break-even volume. So that's a convoluted way to say how much more do we sell on average above and beyond break-even, right? So if I sell a whole lot more than my break-even, I've got a really good margin of safety. So my sales could drop a lot and I'd still at least break even or make some money. Okay. So if a firm's margin of safety is large, given expected sales, the risk of suffering a loss is relatively small. Okay. Now, if their margin of safety is small, then the risk of having a loss is large. Okay. So it's basically how much more average sales do I typically have above and beyond what my break-even point is. The higher the better. The higher that number is, the more safety I have. Operating leverage is another ratio we can take a look at. Operating ratio is use of fixed costs to extract a higher percentage. So how good am I at using my fixed expenses, which is a lot of my property, plant, equipment type stuff, at earning contribution margin? Okay. So my degree of operating leverage boils down to a ratio of contribution margin divided by profit. And obviously the higher the better. Sensitivity analysis, we've already looked at that, kind of that what if scenario, right? And part of it too is even with my CVP formula, when I just look at that relationship between cost, volume, profit, and part of that is, okay, let's say, what if I invest in automation? What if I decide with my company, if I invest in some fixed equipment, some very efficient computerized manufacturing systems that are expensive, but by increasing in those, my fixed cost goes up, but my variable cost will go down dramatically. So that's part of it too. If I can somehow change that relationship between cost, volume, and profit, primarily by adjusting sales mixes, my fixed cost, my variable cost, how will that change my break-even point? How will that change my expected profits? That's the other thing you can do with sensitivity analysis. So you can kind of figure that out. You can say, okay, we're a very manually driven company, which means my variable cost is pretty high. But if I decide to say, let's invest in technology, which my fixed cost will go up, my variable cost will go down, how will that change my profitability? How will it affect my break-even point? That's what this will do for us too. And that's this graph here, which is on the bottom of page 849, right? So this kind of just gives you a feel for if my company is more manual based versus automated, how will these things be different, right? Variable costs are higher in a manual system, lower in an automated system. Fixed costs, vice versa, right? Fixed costs are higher with automation, but lower with manual, and you can kind of just see how that all works out. And it's very possible that based on what I make, I may not really have a choice, right? I might be stuck with one or the other based on whatever product I'm making. But when I have a choice, understanding CVP can help me figure this out. Okay, so also know that CVP basically says all costs can be divided between fixed and variable. That's kind of the basic foundation for CVP analysis. On page 850 and 851, they begin to throw in another wrench into this by saying, what if we used ABC? Okay, so activity-based system divides costs into unit and non-unit based categories. And we also assume in CVP that all costs are assumed to be a linear function of sales. Okay, so I just want you to be aware of this, and I don't believe I have any number crunching based on this. It was more that I just wanted you to be aware of it. I did not get into this when you do your problems in Cengage now. I don't have anything that deals with this in activity-based costing. So just aware of it. That's really all I want you to be concerned about. So I'm not going to go through these. Really just know that that first screen we looked at here that talked about it, this one right here, the differences are CVP assumes all costs can be divided into variable and fixed, where an activity says we're going to divide costs into unit and non-unit based categories. So just be aware of that, but I'm not going to have you crunch any numbers on it. Okay, so as usual at the end of a chapter, there's certain things I want you to take a look at. The terms and definitions are on the bottom of page 855. The terms are there. Be aware of those. Those are always good to review before you take the quiz for the chapter. They're also good to review before you take the test for the chapter also. And then discussion questions are on page 857. And then there's several cornerstones. And what I will do when we do the WebEx for that week for chapter 16, I'm going to walk through a couple of these with you. I feel like I really should with this chapter, so that will be coming. Of course, you can work them on your own. The answers, you have the answers, so if you don't want to wait for me to record that, you can certainly work through them on your own. You don't have to work through every single one, but most of them will be helpful. I would say probably the ones that will be the best for you to work through would be 1 through 5 would cover the core concepts. We're going to cover that. I will show you or have you do in Cengage now, 1 through 5. Actually, I should actually be 1 through 6, which is almost all of them, 1 through 6, because I am asking you a margin of safety question in Cengage now. Okay, as always, if you have questions, just let me know. Very happy to help you out, answer questions for you, and we'll go from there. Thanks.